You're listening to another episode of the Young Investors Podcast, so sit back and relax as myself, Brandon, and my buddy Hamish discuss the latest in the world of finance and stock market investing. Now, a quick reminder before we get into the podcast is that nothing in this podcast should be taken on as personal financial advice. If you're ever unsure about your finances or investing and you need some help, make sure you reach out to a qualified financial advisor. But with all that said, let's get into another episode of the Young Investors Podcast.
All right, welcome back, everybody. Welcome to this week's episode of the Young Investors Podcast. We've got a little bit of a different technical situation at the moment because Brandon is on holiday at the moment. So we're working with a little bit of a lag between connection that we normally don't have. But how you doing, Brandon? How are you going?
Yeah, I'm going all right. Yeah, I'm on the road. I'm having a good time, but still making time, of course, for the Young Investors Podcast. We cannot break. So no, it's not an epic streak anymore because you were sick a couple times.
Because I ruined it.
How dare you? Yeah, exactly. But no. Like obviously we want to keep this podcast weekly when we can, and we also obviously don't want to have to pre-record too many episodes because the idea is that we talk about what's going on that week. So it doesn't really work all the time if you have a lot of pre-recorded episodes trying to guess the news or whatever. But yeah, there's actually a lot to talk about today. A lot to talk about. So yeah, I'm looking forward to it. Good podcast coming up, I reckon. Hopefully the technical stuff holds up as well. Fingers crossed that everything holds up.
Yeah, we'll do our best here today. We've got, as I mentioned last week, we've got a bunch of inflation data out of the US and Australia, which we won't spend too much time on because we kind of get a lot of inflation data, so we don't want to dedicate too much of the podcast to talking about that, but we will go through both of those. There's been an interesting proxy battle between Disney and a major shareholder at Disney, which I'm sure a lot of people have seen bits and pieces of over the last couple of weeks. Microsoft investing in OpenAI, investing more into OpenAI. So Brandon's got an interesting story there and a bunch of other stuff. The World Economic Forum just kicked off in Davos, which is a kind of an annual event where a lot of the global elites, I guess, get together and talk about how they should run the world. No, but we get some interesting insights from investors there as well. So we'll go through that, and we've got a couple other stories, but we'll see. We'll kind of see how we go with time for today. Sound good?
Yep, sounds good. Yep. Sorry, we're trying real hard with this lag here, but I reckon we just crack on with the sponsor. And then we'll get into it, have a bit of a yarn, because we do have a lot to get through, don't we?
Yeah, we do for sure. Today's episode is sponsored by Sharesight, which is an application you can use to track the performance of your stock portfolio. So you can bring in all of your trades either automatically by connecting your broker to Sharesight, or you can do it manually if you want. Download your trades using Excel or one by one. Once you do that, it will track all the gains and losses in your portfolio. So capital gains, dividends. If you have dividend reinvestment plans, it will do those calculations for you. Currency gains, if you're buying shares internationally or you hold foreign currencies. And then you can also use it for when it comes to tax time. So Sharesight generates up to 12 different reports that can be used at tax time to work out things such as capital gains, dividend income, and more. At the moment, you can try Sharesight for free by heading over to sharesight.com/young investors. That site spelled SIGHT, sharesight.com/young investors. So use that link. You can sign up to a free plan where you can track up to 10 holdings, so stocks, ETFs, that kind of thing, for as long as you want. So you can try it out. And maybe your portfolio has less than 10 holdings, so you might even be able to get away with using the free plan forever. But if you do want to sign up to more premium features for more reporting and that sort of thing, benchmarking, then you can also use that link and you'll get 4 months off an annual paid subscription if you're interested. So go check it out, sharesight.com/young investors. And as always, huge thank you to people who end up signing up to Sharesight and do so through our link and supporting the podcast in a small way.
Indeed. Now, Hamish, this is interesting. You said last week we were going to look at the inflation stats. I have been so much in holiday mode, I haven't even seen the numbers.
Wow. Really?
Australia or the US. I haven't even seen the US inflation number. So I'm going to let you wow me.
Yeah.
What do we predict? I predicted last week that it was going to continue to trend down. I can't remember what numbers we said though, but we both said it was going to continue trending down. So I'm interested if that actually if that actually came true. Take us through it.
Yeah, to give some context, the previous month in the US, annual inflation was recorded at 7.1%. And then last week, briefly, we spoke about how the consensus expectation was, I think it was 6.6%. And we're kind of making fun of some fund manager that was like, oh, well, I think it's going to be 6.5%, which is, great. You think it's going to be the consensus.
Classic.
Good on you. But I was making fun of that fund manager, and they were correct. So maybe we should be listening to that person. So can't remember
really?
who's what her name was, but we should go find it. No, but annual inflation came in at 6.5%, which, as I mentioned, was down from 7.1%, which was recorded last month. Very interestingly, the month-over-month inflation rate was negative 0.1%, which is technically deflation for 1 month. So, obviously a continued slowdown. If you actually look at the US over the past 6 months, which I added it together, US inflation has totaled 0.9% over 6 months. Over the last 6 months, at least the headline inflation figure, which we'll get to some deeper numbers as well, but the headline inflation figure has been slowing considerably and continues to do so over the past 6 months. Is that what you expected?
Well, I just was following a trend. I expected it maybe to just continue its trend down. But that's really interesting about the month-over-month inflation, now deflation. Because, in the last 6 months, the US has totaled 0.9%. So if you do that for another 6 months, then you've got an annual inflation rate of what the Fed would be comfortable with, which is pretty crazy.
Yeah, it is really interesting, and when you dive into the numbers, it's it's the headline number doesn't really tell that much of the story. It's more about the smaller components that make it up. So, what's driving the decrease in December? It's energy. So energy has continued to come off as it has for a few months, negative 4.5%. During the month, gasoline was negative 9.4%. Fuel oil was negative 16.6%. Gas was actually up 3%, and then food was down 0.3%. So some massive decreases in energy, which
That's huge, actually.
Yeah, exactly. I mean, negative 17% on fuel oil in a month. So that's putting a lot of downward pressure on inflation. But that's why I say the specific components kind of matter here, because even though the headline number was down, if we again strip out energy and food, both of which have been, but mostly energy, have been coming down a lot, and we just look at the core CPI data, excluding energy and food, then the story is not as like deflationary or low inflation as it looks at the top level.
Right.
So core CPI came in at 5.7% annually, or grew 5.7%. Continued the downtrend, was down from 6% recorded last month, but the month-over-month increase was still 0.3%. And if you look at core inflation over the past 6 months, it's been 2.3%. So, still running a little bit hot, but a lot better than it has been recently. Yeah, I mean, again, as you said, if you kind of extrapolate that past 6 months of core inflation to a year, you're talking about around 5% inflation, but it's still a lot less than what it's been recently.
I don't know if I have too much to add to that. We got to go through. I've been seeing so many memes though lately of of people being like ways to become a millionaire in 2023, and it's just like a picture of an egg farmer. I think I can't remember. Eggs have gone up like crazy. Actually, you've got here. The items which saw the most inflation in 2022. Let's go through that. That looks interesting.
Yeah, it's funny. Eggs are the new crypto. It's hoarding eggs
actually
now. And buying chickens. Of course, we've now got in the US 2022 annual inflation. So we're at the end, we've just recorded essentially the whole year of 2022. So CNBC did an article looking at which items saw the most inflation specifically, which is always kind of funny. And we were talking about last year, I think it was all breakfast items, and it's still all breakfast items for some weird reason. Eggs
most expensive meal of the day.
Yeah, exactly. Most important and most expensive. Ridiculous. So eggs was up 60% or 59.9% annually. Butter was 35.3%. Wow. There's lettuce on the list, 24.9%. And then out of food, fuel oil was 41.5%. So fuel oil was still up massively in 2022. And then airfares was another interesting one, 28.5%. So, yeah, some big movers. Eggs, yeah.
I was going to say, I wonder if airfares going up is a result of them maybe being depressed in 2021. I don't know. I would have to look into that. I'd have to look into that further, because you could, like a lot of things, you know, maybe the airlines were like, quick, cheap flights, come on, everybody, come back. And now maybe that effect has kind of slowed down, so it looks like there's been a massive inflation of airfares, but I don't know. I'd have to look more into that. That's just speculation as to why it might have inflated so much.
Yeah, I definitely can't say I've looked at the airline industry closely, but I would imagine that's probably part of it. I would imagine that the increase in oil as well is a big part of their expenses, is probably driving part of that.
Yep.
I'm sure the combination of those two are the majority of that impact for airlines. So that's
probably just demand, people wanting to go on holidays again.
Yeah, exactly. People looking to spend their. That's the other funny thing is, I think if you look at the US savings rates, it's kind of astounding. You look at the chart; it's pretty consistent over most decades, and then there's this massive spike in savings rates during the pandemic as people got stimulus and people were not going out as much. And then the savings rate went from just record highs to now it's record lows, like for the last many decades. So it really has been, people stayed at home, saved a bunch of money. And then the last couple of years, people have just been so keen to just do things that they've just depleted their savings rates right down to record lows. It's that's kind of one of the fascinating things that's been seen. Yeah, so that's US inflation. Not too much more to talk about that, but we can talk about Australian inflation, which I'm sure interests a lot of our viewers, and is one, of course, that we like to follow as well. And as of a couple of months ago, we now get monthly inflation data out of Australia, so we can, same as US, keep up to date month by month instead of quarterly, which it was previously. So essentially, we have the November figure. So we've just had the November figure released, and I have no idea why Australia did this, but the December figure comes out in 15 days. So it's very odd. Yeah. So they do
you think this is because this is like the first time? Is it how long have we had month to month inflation figures? Maybe it's just like Australian, I don't know, Bureau of Statistics or whatever it is, trying to get their stuff together and trying to figure out a good schedule. Maybe, I don't know. How long have we had month to month inflation data for Australia?
It's just been since October. So the quarter ended September was the last quarterly figure. And then they did October, which was a monthly figure. And they released the October one. It was like a month and a half late. And they're doing the same thing with the December figure. But then for some reason, the November figure. But then for some reason, they're giving us the December figure really early. So in 2 weeks, we'll be able to look at the full year for 2022. But for now, we just have... Maybe
it's got something... it's got something to do with the public service shutdown period. So if they were shut down, they didn't get the inflation stats out in time. So because they're now back on, so maybe that's why it's only just come out now. I don't know. I'm just trying to think of why that might be.
Yeah, it could very well be, something like that. But regardless, annual inflation to the end of November reached 7.3%, which was up from 6.9%, which was recorded in October. And the 7.3 equals our highest recorded figure during this inflation crisis, which was also set in September. So it went September, 7.3, and then it dipped a little bit, and now we're back up at 7.3. So unlike the US, which has seen 6 months now, I think, of persistently declining inflation, we're still on the way up, which is interesting. So what's driving inflation? We can kind of look at the categories, same as the US. So in terms of housing, new dwellings, so new homes rose 17.9% year over year. And that's essentially as builders are passing on the higher labor and material costs to buyers. Rent rose 3.6%. In terms of food, meals and takeaway rose 7.3%. Bloody Uber Eats keeps hiking their bloody rates.
I found a funny article. Sorry, this is not relevant, but what was it? Like Uber it got so popular because obviously it was cheaper, better way of doing ride sharing and whatnot, and it just absolutely beat the hell out of taxis. And now it's come full circle, and in most instances, taxis are now cheaper than Uber. And they have the same functionality now as well, where if you download like the 13 Cabs app, you can actually, it just acts like Uber as well. How crazy is that? Sorry. That's just a bit of a tangent.
No, and it's very true. And there's nothing, I mean, maybe I'm missing something, but what's proprietary about what Uber does? I mean, every driver drives for Uber, Lyft, and every single car, they have the same, all the stickers on their car. They have all the apps open. So there's
all of them.
There's no like proprietary drivers or network, and everyone can have every app and just look for like whether it's cabs or whatever, DD or whatever it is. So it's kind of odd. It's like, yeah, you would imagine in a market like that, it would just become, like the playing field would eventually level out instead of having Uber being way cheaper than cabs and that sort of thing. So is interesting to see. But yes, so and then in terms of other food, we had fruit and vegetables up 9.5%. Energy rose 16.6%. These are all annual figures, by the way, not monthly, but annual figures.
Jeez.
Yeah. Don't worry, we're not seeing a 10% increase in fruit and vegetable in a month. That would be kind of something. And then we had furniture and household equipment up 9.4% and holiday and travel and accommodation up at 12.8%. So basically everything has continued to be up a lot. Which is interesting because, we theorized a little bit in a couple of earlier episodes how maybe the increased variable loans that people have in Australia would mean that less interest rate hikes would be needed to get people to kind of tighten the belt, especially on some discretionary purchases. But looking at things like holiday travel and even, furniture and household items still skyrocketing, it shows that people are still aggressively making discretionary purchases they don't need, which means that the interest rate hikes haven't had, at least yet, that much of an effect on people's spending.
This is, you're right. It is annoying that we're getting November data now, because I was just looking when you said energy and fuel rose 16.6. I was like, that's so weird because in the States it went down 16, and I'm like, different time periods. Australia's November, US is December. God damn, we need to sync up here, guys. Come on. I guess we have to wait 15 days, right?
Yeah, and the other thing to note is that even though fuel rose in November, the price of fuel, the average price of fuel rose from October to November, month over month, but the price also declined through November. So most of the higher price was at the beginning of November. By the end, it was well below the October low. So it has been trending down, as you just said, since what we'll basically see the downtrend probably in December.
From November to December,
yeah. So, which we see in 15 days. So we'll be back. We'll be back in 2 weeks to talk about that.
A couple weeks.
Yeah.
Oh, very good. There you go. So yeah, interesting. I didn't know that Australian inflation was that high, 7.3%. Ay.
Yeah.
But I don't know. We'll see. So I guess we're going to have more interest rate hikes. Hooray, good for my upcoming mortgage.
Yeah, I know. Hooray. No, and that's the other thing.
Hooray.
The meeting is the beginning of the first Tuesday of February. So beginning of February,
okay.
We will see whether they'll hike rates, which I would anticipate they will. But do you want to take us, cool. Where do you want to take us? Do you want to take us through the Microsoft investing more into OpenAI, ChatGPT?
Yeah, very interesting. Yeah. I've been playing around with ChatGPT so much.
It's good fun.
Have you really given it it's so crazy, man. It can do anything. It's really, I was looking, someone compared it to like, or they explained why they're not that impressed with ChatGPT, because their reasoning was ChatGPT is just what a calculator is to numbers, but for reading and writing. That's basically what ChatGPT is. So it's like, imagine when the first calculator came out, people would have been like, oh my God, that's amazing. Look, I can do all these sums and these figures, and I can just do it on this little calculator here. And then they compared it to OpenAI is essentially a calculator, but for words instead of for numbers. I thought that was an interesting way of thinking about it.
Yeah, that is interesting. And well, I mean, for someone who's illiterate like me, then it's very helpful.
Yeah, numbers are my strong suit, not the whole reading, writing stuff.
Yeah.
Microsoft, they're going to invest more in OpenAI. So they clearly like what ChatGPT is about. And it's no surprise because it is flippin' amazing. By the way, if you just haven't used ChatGPT, just try it. Ask it anything. Ask it to write you an essay on something. It will blow your mind. And I'm not kidding. But anyway, on topic. Microsoft plans to invest $10 billion in OpenAI, the startup behind popular artificial intelligence tool ChatGPT, according to a report from Semaphore. The deal is a part of a funding round with other investors involved that would value OpenAI at a whopping $29 billion. That is a very, very high valuation for ChatGPT, but there you go. I mean, it is a very powerful tool. I feel like it's going to be used in a lot of situations. But anyway, $29 billion valuation, Semaphore reported on Tuesday, citing people, there we go, familiar with the matter, allegedly. It isn't clear whether the deal has been finalized, but term sheets sent to prospective investors indicated the plan was to close the deal by the end of 2022. Well, we have not heard if that happened. Microsoft will reportedly get a 75% share of OpenAI's profits until it makes back the money on its investment, after which the company would assume a 49% stake in OpenAI. The AI model itself. Sorry, you giggling over there?
I was just gonna say that sounds like a Kevin O'Leary Shark Tank deal. Like I want a $1 royalty. I want 50 cents on every dollar of sales until I get my money back. Like
yeah. For every dollar that you make, you give me $1.50.
Yeah. Until I'm rich, and then
until you're broken up rich and all your money is my money, and then I'll move on. The AI model itself, a variant of the GPT-3 family of large language models, has been used for everything from developing code to writing college essays. A bet on ChatGPT could help Microsoft boost its efforts in web search, a market that's obviously dominated by Google. Who would have thought? How the company's Bing browser only has a small share of the global search engine market because it sucks. Sorry, that was my words. However, it is hoped the deal could help the firm chip away at Google's dominance by offering more advanced search capabilities. In December, Morgan Stanley published a report examining whether ChatGPT is a threat to Google. Brian Nowak, the bank's lead analyst on Alphabet, wrote that language models could take market share and, quote, disrupt Google's position as the entry point for people on the internet. OpenAI was founded by Silicon Valley entrepreneur Sam Altman in 2015, launched its ChatGPT in late November. Blah, 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 blah. There you go. Crossed, when was it? 5 days. 5 days after ChatGPT was released, it crossed 1 million users. How crazy is that? Did you see that when it came out? Yeah,
it's certainly been extremely popular, and I kind of get that argument that it's, you know, maybe it would be, I think, an ambitious call to say that ChatGPT in its current state would just, you know, could replace something like Google, but to take maybe to slice out a larger piece of the market as people splitting how they search on the internet from just being, you know, Google to being Google, and then when they want to, you know, build a health plan or an exercise regime or whatever it is, using something where it's a little bit more descriptive. And you can kind of go back and forth, which ChatGPT seems to be quite good at. Whether or not the information that you get out of it is accurate, I'm not sure, but certainly the way that you interact with it is fascinating and gives you kind of a glimpse into, I think, where search will probably end up over time. It makes sense. I mean, you can think of combining ChatGPT with like a voice assistant. That's kind of the pinnacle of like actually having an assistant. A virtual assistant is someone you can just talk to, and the Google talks back to you, and you can just kind of go back and forth, and it has context and that sort of thing. So it's very fascinating. I like these new tech things come out, because even if it's not great or fantastic in its current state, it just gives you like a glimpse of where we're going. And that to me is really interesting. Same with like VR, like VR's, or even the current like kind of mixed reality. It's not great at the moment, but it gives you a glimpse of, okay, if this technology keeps advancing for 20, 30 years, it's going to be incredibly impressive, and it gives you kind of a glimpse into where we're heading technology wise.
Yeah, it is pretty insane. It's just so. I think you're right. It will be a much more utilized way of searching in the future, and I think Google should take note, because it is so, like, with Google, they've got the monopoly. So you search something, and then what are you greeted with? You're greeted with the 1, 2, 3rd link. First of all, you're not greeted with the information in depth straight away. You are greeted with a little blurb. And sometimes when you look up something obvious, like, I don't know, how old is Brad Pitt or something, it'll just come up straight away.
Yeah.
But at the same time, when you kind of like trying to research something, you know you're going to get bang, 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 3 or 4 businesses that have firstly paid to be there. They might not be the first. They might not be the best source of information. You just get ad, and then you scroll down, and then you've got to actually sift through yourself. What resource do I want to use to access this information? What do I trust? What do I not trust? What's clickbaiting me? What's like .org or something, or something .gov might be more like trustworthy. So you've got to do that work yourself. ChatGPT takes that away, and it makes it very obvious. Like, for example, I literally just opened ChatGPT and I said chocolate cake recipe and hit enter. And it's said ingredients, 1 3/4 cups of all-purpose flour, 3/4 cup of unsweetened cocoa butter. It's got all the ingredients listed with quantities, and then it's got instructions. Preheat oven to 180 degrees Celsius, grease the pan. In large mixing bowl, sift together flour. And this is just AI coming up with this. In a large mixing bowl, sift together the flour, cocoa powder, sugar, baking powder, baking soda, and salt. In a separate mixing bowl, whisk together the eggs, milk, oil, and vanilla extract. Gradually add the wet ingredients and the dry ingredients, and it just goes through and it tells you exactly how to do it.
Yeah.
So honestly, if you just wanted the answer, ChatGPT seems to be a better way of getting what you need faster. But obviously, it's not very, it's not well monetized.
Yeah,
because there's no one paying to kind of be on there.
But
it does take out a couple of steps of the process. The only thing that I worry about is that ChatGPT can get things wrong. It tries its best, and it's a language model, so it sounds really good. It sounds like it's super pro because it's a language model, but sometimes it gets things wrong.
Yeah. I think that example you gave with the cake recipe is a really good way to understand what ChatGPT is, because Google, if you search for a cake recipe, you are sifting through all of the different websites that are offering different cake recipes, whereas ChatGPT is using its own algorithm to feed you one, right? So it's kind of like having a very intelligent person built on some kind of algorithm that is in between you and Google search. Like, it's taking in the information from Google essentially and choosing what you to feed to you. And I think that does have value. I think there's certainly value in you being the one who gets to kind of select through different choices. Like, in some circumstances, you just want a cake recipe, and then you can ask it, no, give me another one, or give me one with caramel, or whatever it is, right? But I think there's still going to be value in searching for a cake recipe and then you doing the filtering yourself to choose, from a list, if that makes sense. But maybe ChatGPT can do that over time as well. I don't know. I don't understand this tech all that well, but yeah, it is certainly interesting.
Yeah, it's pretty insane. I'm asking it, when did Warren Buffett invest in Coca-Cola? Warren Buffett's investment company, Berkshire Hathaway, first invested in Coca-Cola in the late 1980s. The exact date of the initial investment is not publicly disclosed, but it is known that Berkshire Hathaway purchased a significant amount of Coca-Cola stock in 1988 and 1989. Berkshire Hathaway has continued to hold onto the stock and has even increased its position over the years, making it one of the company's largest shareholders. As of 2021, Berkshire Hathaway owns more than 400 million shares of Coca-Cola, worth over $20 billion.
Well, that's correct. they didn't get that wrong.
Correct. No, they did not. But it's crazy, just like, to get that kind of succinct amount of information, because that told me everything I needed to know. To get that amount of succinct information, exactly what I needed, doing it through Google search would still take me like, click this, read a little bit there. Maybe they didn't. Maybe they said he first bought in 1988, but they didn't say he also bought in 1989. Or maybe it didn't say what it's worth today. So it's just that amazing ability to just scrape through. Anyway, anyway, ChatGPT is awesome.
Yeah, I think that's a good point. I think if it's fact based, like if you're looking for facts, then it has the potential to be very good as long as it's getting the right facts. But assuming it's getting the right facts, then it's fantastic. In terms of opinion stuff, that's where it's like it's going to feed you a particular narrative, and maybe that's the consensus narrative on a particular topic. But there still will be value in you seeing a bunch of different opinions and researching for yourself rather than an algorithm. I think. Like the essay topic argument of like, write me an essay on this particular topic. It's going to pick a particular narrative depending on the topic. Let's say it's politics, right? It's going to pick a narrative and a way to structure it that may not be consensus, or even if it is, maybe there's another dominant argument. So yeah, but certainly for like fact stuff, it is so fast. And even for some creative stuff, like sometimes I'll use it to write me like 20 YouTube titles, and I'll never take one directly from there, but it inspires me like, oh, that's a good adjective. Like, that's it. Like not just using scary in the title or whatever it is, like what's a different word that, alarming I used in one of my videos. I literally got that word from pulling up titles from ChatGPT. So
it's pretty good, eh?
Yeah, it is interesting in a creative aspect as well.
So long story short, Microsoft's is rumored to invest $10 billion in OpenAI. Whoop-de-doo. Before we move on, one thing I didn't know is that Microsoft is actually already a shareholder in OpenAI. Right. I just didn't know that. So the company first invested $1 billion in OpenAI back in 2019. Okay. And interestingly, then the deal was that there's 3 points. Microsoft and OpenAI will jointly build new Azure AI supercomputing technologies. Then OpenAI will port its services to run on Microsoft Azure, which it will use to create new AI technologies and deliver on the promise of artificial general intelligence. And then thirdly, Microsoft will become OpenAI's preferred partner for commercializing new AI technologies. And interestingly, with that said, so they said that back in 2019, then we get some more news this week that Microsoft is giving more people, or at least more customers, access to OpenAI's technologies, including ChatGPT. The tech giant has announced that it is now making Azure OpenAI service generally available after giving a limited number of enterprise customers access to it when it debuted in November 2021. As Bloomberg notes, customers who have access to the service can use various OpenAI tools for their own cloud applications, including the DALL-E art generator and the ChatGPT 3.5 language system. Microsoft says it's also adding access to it wasn't ChatGPT, it was the GPT 3.5 language system. Microsoft said it's also adding access to ChatGPT, which it describes as a fine-tuned version of GPT 3.5. And that's coming to the service soon. Quote, these AI models are going to change the way that people interact with computers, Microsoft's head of AI platforms, Eric Boyd, previously told the Financial Times. So there you go. They said that they were going to partner up with Microsoft, and that I think Microsoft will be pretty happy that they signed that little agreement back in 2019, because it seems like they've got a pretty strong commercial link with OpenAI, which will, I imagine, be very beneficial to Microsoft over time, but we'll have to wait and see.
Yeah, for sure. Is that all we had for that story?
Can you please tell me about what is going on with this Disney business? Bob Iger's saying, sit down, I'm running the company.
Yeah, it's this kind of came out of nowhere. This story, this kind of proxy battle between Disney and Trian, which is a company that an investment firm that's invested now in Disney. It started kind of last week, and it's progressed with kind of news updates throughout this week, and it kind of took me a little bit by surprise. It kind of came out of nowhere, really, and does come shortly after, of course, Bob Iger took over or came back, taking over from what's his name, Bob
Chapek.
Bob Chapek. Fired Bob was replaced with Disney, old time Disney Bob.
Bob.
Yeah, old Bob. But anyway, so I'll run through what happened last week with kind of the proxy battle, and then what the update is this week. So last week, Nelson Peltz, who founded and runs a Trian Capital Management, which has about $4 billion of assets under management, acquired a $1 billion stake in Disney. So it's a reasonable sized position in Disney, which has a market cap of, I think, 180 billion. So it's not, it's not an enormous position. It's about 0.5%. But it is certainly an enormous position out of Mr. Peltz's capital, which he's investing. So in that respect, it's large, and $1 billion just in nominal terms is large anyway. So what happened shortly after making this position is he essentially published a presentation accusing Disney, among other things, of basically poor management and requesting a seat on the board of directors to help push through some improved changes in a number of different fronts. So he's essentially taking what's called an activist approach when it comes to Disney, which the likes of Bill Ackman and Carl Icahn do this quite frequently, where they build large positions in a company. They then do a presentation talking about some of the things they think could be changed in the business. They push for either one or multiple board seats, and then they push through changes, whether that means to change parts of the management team or change actions that the management team is pursuing. So that's kind of what's going on here. Except, as I mentioned in this case, he doesn't have a large percentage of the shares. It's if we could do a comparison to Elon Musk just a short while ago, he took, I think, almost a 20% position in Twitter when he pushed for a seat on the board, and I think he got the seat in the end. I can't exactly remember.
I can't quite remember. I think he was going to join the board and then he declined or something like that. It was a bit messy because at that point he just said, "Screw it, I'm just going to buy the whole thing." Yes,
and the difference between that situation is that Twitter was I think Twitter ended up offering him a seat on the board, and they kind of had to because he had such a large equity position in the company. Whereas in this case, as I said, less than 1% ownership, but still a large amount. And essentially all of this kind of comes in as a backdrop of Disney, which went from hugely outperforming the S&P 500 up until the beginning of COVID, if you look at their track record, and then and also compared to their media peers, to after the pandemic, massively underperforming the S&P 500 and a lot of their media peers as well. And in 2022 alone, the stock is down 45%. So the backdrop is that the stock hasn't been doing very well. Essentially, Peltz put together a case that a presentation that was 35 pages long, so it's massive. You can go give it a read if you want. I'm obviously not going to talk about everything that was in there because it's enormous. But a couple of kind of the key points were that he pointed out Disney has been underperforming the S&P 500 over 1, 3, 5, and 10-year averages. So it's not just a short-term thing. It's now over a very long period of time. They cut the dividend, which had been in place for 57 years in a row. They recently cut that to pursue streaming and also to protect themselves because they had taken on a large amount of debt. And that was kind of the next issue, which is that they took on too much debt and overpaid for the Fox acquisition, which was $71 billion, which is an enormous acquisition. It was basically a merger, really, because it was almost half the size of Disney. And essentially, so on the acquisition, this was a big point of the presentation, a number of slides on this. Revenue after the acquisition has grown 41%, but earnings per share is still 50% below where it was before the acquisition. So
right,
yes, so
that doesn't sound great, does it?
Yeah, so in other words, if they didn't do the acquisition, yes, they'd have less revenue, but they'd be making twice as much profit. At least that's the contention he's kind of making. And this kind of comes from two parts. One is partly dilution, so they had to issue a lot of shares and give them to the previous Fox shareholders as a part of the deal. So that was how they paid for part of the deal. So there was a lot of dilution, which put downward pressure on earnings per share, and then a lot of higher costs as well. On one slide, he talks about how Disney said that they were going to get to about $13.3 billion in EBIT earnings after the acquisition, and they're currently at $3 billion, which is an absolute tiny fraction of where they thought they would be. And even if you account for the $4 billion of losses in streaming, which you could say is kind of this separate thing, they'd still be only at $7.1 billion, which is, again, about half of where they were even before the acquisition. So that's kind of like the main point. He had some points on streaming as well. There was a couple of slides pointing out how if you use Disney's own projections for revenue and profitability, that they're operating far less efficiently than Netflix, which is, he points out, is odd because you would expect that their IP, their library of brands should allow them to be more efficient, that they should be able to leverage Marvel and Lucasfilm to generate higher margins than Netflix, and that's not currently the case or even projected to be the case. And there was a bunch of other stuff on management compensation and a bunch of other things that he had kind of complaints about. So yeah, it was kind of negative. Negative.
Well,
week.
I would say that it sounds like this guy's got a bit of a point, especially if Disney. I haven't paid super close attention to Disney in a while, but if they were saying that, they were going to get to 13.3 billion EBIT, and then I wonder when did they say that? Do you know? Like before the acquisition?
Yeah. So this is
or during the acquisition process.
Yeah. So when they do an acquisition, there's typically like a presentation where they talk about the synergies is the token finance world, and they thought they'd be able to get $2 billion in synergies additional earnings, and if you add Disney's acquisition earnings plus Fox's pre-acquisition earnings plus the $2 billion in synergies, that's where you get to the $13 billion figure. If you just so theoretically, if you just combined the two businesses and then plus $2 billion, that's where they should be, and they're far below that. And Disney has, to give them credit, they have some reasonable arguments, I think, for why they're not there currently. But yeah, it was certainly a very negative and powerful presentation. As I said, 35 pages. It's massive. So that they kind of went through a lot of things. But then this week, Disney responded. So Disney, as he said, Bob Iger said, no. And
listen to me.
Yeah.
I'm head Bob now.
Yeah, so Peltz didn't get his seat on the board as he requested. Unanimously, the board voted to deny him, and the main kind of reason for denying him was that he didn't have any experience in media, and that he didn't know what he was talking about, and that's what a lot of the presentation was basically saying. Well, this is what he thinks, and this is what's the reality. They didn't cover everything, which was disappointing. It was like a 6-page response or something, so it was a lot shorter. And they didn't cover anything about Bob Iger's compensation, which was a massive thing that I won't get into, but it was kind of disappointing to see they didn't respond to that. But on the Fox acquisition, they said that the acquisition is worth it because it will facilitate long-term transition to streaming. They reiterated that they see it as being a good deal long-term, and they essentially cited the COVID impact, particularly on parks and their cruise business, and then the streaming investments for the reason why the earnings are not back to pre-COVID levels. So they're basically saying that it's not related to the acquisition of Fox. It's more related to the fact that they're not just a media business; they have these physical high capex components that have suffered a lot during COVID.
Yeah, that's what I would have said in response. It's like, come on, we're talking about the Fox acquisition. We're not talking about the fact that COVID closed all of our theme parks. We're not talking about like what we were saying last week. Box office attendance is like way down still. It's like, come on, give us a break. We're trying to like reboot our entire business after this massive pandemic has absolutely slaughtered us. Give us a chance here.
Yeah, I think it is difficult, at least I find it really difficult to judge the income statement or the financial statements of these media companies at the moment because, yes, the things you just listed, and then also they're investing a lot into streaming, and it's difficult to say, how much of that is going to bear fruit in the future, or how much of that is just burning money hand over fist right now. So it is difficult.
But it just looks like an impairment right now. It just looks like
exactly
cop it.
Yes, exactly. One thing I always look to when these reports kind of happen is is the management team being kind of honest in their response, or are they being a little bit tricky? And this is one thing I didn't particularly like about Disney's response. Was they showed on one of the first slides, they showed a stock chart of when Bob Iger was CEO, and they essentially showed that when he was CEO, the stock had performed twice as well as the S&P 500. But the chart is pretty misleading because Bob Iger resigned in February of 2020, which was right before all the pain started for Disney. So they're showing this chart which excludes the last 2 years where the stock has performed terribly, and that's where all the issues have arrived. And on top of that, Bob Iger was taking credit for still working at Disney during the pandemic. During late 2020, he came out and said, "Hey, even though I handed over the reins, I'm still chairman and I'm still executive chairman. I'm still working in the business. Don't worry, guys, I'm steering the ship."
He did say that.
And now Disney is kind of coming out and saying, well, no. He wasn't CEO. He was done. He was done. He had no involvement in the company. So to me, that's a bit disingenuous, which I didn't like. But then I also get that they've got to be, they're trying to put their best foot forward. But I prefer honesty and over warping the facts, warping the charts to suit kind of their particular narrative. But that was kind of the main thing out of their response. As I said, there wasn't a huge amount that they gave in response. It was fairly limited. But there you go. That's the.
I kind of hope Bob Chapek's getting a fat payout from Disney, because they're just basically like, dude, look, the investors are unhappy. We need to get rid of you. We're basically now going to blame everything bad that's happened over the past few years on you, so that we can try and restore investor confidence. Can you just take that hit for us? We'd really appreciate it.
Yeah. Well, that's
it's just Bob's fault. It's Chapek's fault over there. No, Iger. No, he's a magician. Don't worry. Bob Iger is mwah, and he's back, everybody. So stock goes up now, please.
Yeah. Well, if you want to get conspiratorial, then you could argue that they saw the pandemic coming. They removed Bob Iger so they wouldn't affect his legacy. They put Chapek in because they wanted to get rid of him anyway. They put him into a position he wasn't ready for. And then now that the market looks like it's going up again, they bring Iger back in and they can fight proxy battles and say, hey, look, but we've got Iger who has never caused a problem.
Yeah. God damn, that's genius. Yeah. Oh my God.
No, I don't think that's what happened. But yeah.
That would be pretty funny. Interesting. So just threw it out straight away. Sorry, mate, you're not coming on the board. Unanimously go and take a seat somewhere else. Interesting. Well, see what they do. Hopefully they can see some good results in the next couple of years, because I like Disney.
I do too.
I have a soft spot for Disney. I don't know what they're like. Their financials probably aren't looking too good right now, but I just have a soft spot for them. I don't know. I like companies that just flex creativity and try and just, I don't know, their kind of end product is something joyous and fun. I don't know. Kind of have a soft spot. We need more of those kind of companies. Anyway, what should we talk about next?
Yeah, what have you got for us? Where should we go? We've got about
I'll talk about the World Economic Forum.
Yes, we'll squeeze in this story. Yeah, tell us. I haven't looked too much at this, so.
Yeah, well, honestly, this is not a particularly groundbreaking story. This is just more of like hey, this thing is happening, because if you didn't notice, business leaders and economists have gathered in Davos in Switzerland for the World Economic Forum's annual event. This is an annual, forum, I guess, that goes, this year is going between the 16th and the 20th of January, so it's still ongoing. So if there's stuff that breaks over the next couple of days, we will not have seen that yet. This year, they're greeted with a world buffeted by high inflation and high interest rates that central banks have pushed through to combat the inflation. This has created a threat of recession and has led some of the world's biggest companies to hold their breath and their spending ahead of an uncertain year. Yes, that is correct. Yet some see reasons to think rising inflation sparked in part by Russia's invasion of Ukraine has peaked. That could, as some business leaders hope, presage a soft economic landing. Alternatively, another rise in interest rates could lead to a more prolonged downturn. Many businesses are slashing costs and in some cases jobs to be prudent, several business leaders have said. But a number are also holding out hope that they won't need to cut too deeply to take advantage of what some expect could be a rebound this year if major economies skirt a recession. Whether the US dips into a recession this year remains an open question, many business leaders say. Executives have been preparing for the possibility for months, even as consumer spending has remained fairly strong and the unemployment rate has stood at a historically low 3.5% in December. So that is a bit of background. We probably knew all that already. Some of the things that some people have said, because I think this is just a whole range of different interviews and different talks and whatever that happened at the Economic Forum. So they've said, quote, I haven't heard in 30 years being in business of people talking about a recession for so long, said Christopher Beck, who's the chairman and CEO of Ecolab. Matthew Prince, CEO of cloud infrastructure company Cloudflare, said that, quote, anyone who's not nervous isn't paying attention. Customers are saying these are tough times. Although Larry Summers, the former Treasury Secretary, has said he's become less pessimistic about the Federal Reserve's actions and now believes that the economy is unlikely to experience massive financial trauma in the months ahead. He said Davos attendees, quote, are sort of daring to be hopeful, but not entirely convinced of being hopeful. He's predicted that to bring inflation down, a recession would be necessary. He still doesn't expect a soft landing when growth slows but doesn't turn negative. Quote, but it looks more plausible to me that there will be a soft landing than it did, principally because the economy is staying strong. Then you have, is it Geeta Gopinath? I'm not quite sure. Geeta Gopinath, first Deputy Managing Director of the International Monetary Fund, said, quote, economic performance in both the US and Europe has surprised on the upside since October, when the IMF released its last economic outlook. This has led to risks being, quote, somewhat more balanced going into 2023. Still, she said it would take a few more wage and price inflation reports in line with the restrained increases reportedly. Whoa, what is that sentence? Still, she said it would take a few more wage and price inflation reports in line with the restrained increases reported recently before, quote, we can start feeling much more comfortable about the inflation trajectory. For now, the IMF thinks interest rates in the US will remain at 5% through the year, she said.
Right.
So that was a pretty boring story. Mainly, I just wanted to let everyone know that the World Economic Forum is happening, and you can actually go to their YouTube channel and have a look at a lot of the content that's going down. If you're interested, it's just basically a massive gathering of politicians, business leaders, economists, and they just have a yarn about what they think about things. So interesting. I don't think you should necessarily take a lot out of what they say, but it is interesting kind of hearing what different people think about the economy. But even in the quotes you just heard me read from different business leaders, there is a little bit of difference in opinion depending on who you ask. But
I just love the commentary of people talking about soft landing. I mean, I just, not to be all kind of doom and gloom, but like I feel like every time there's interest rate hikes across time, there's just been commentary of, but there could be a soft landing. They'll get it right and it's just, it never, okay, can someone give me a time where the Fed raised rates aggressively and there was a soft landing? Like there isn't one, because unfortunately that's just how it kind of works. Things oscillate between good and bad across time. Howard Marks talks a lot about, the broad market cycles. Ray Dalio talks a lot about these broad market cycles, and that's just it's kind of human nature. It's just kind of how things unfold. So it is kind of, maybe it will be a soft landing. I don't know, but it is just funny hearing people talk so optimistically about how this is the time, that the one time across history where the aggressive rate hikes in a high inflation environment won't cause a recession. It's just, it seems kind of funny, but
I was just going to say, it's like skydiving without a parachute and hoping that there's a massive trampoline at the bottom somewhere.
Yeah, maybe
it's
this
like,
time.
oh my God, that's amazing. It's a trampoline. I'm saved.
Yeah.
Chances are slim.
Yeah,
But yeah,
pretty
I don't
much.
know. I saw you made a video on Ray Dalio recently. Was that him speaking at the World Economic Forum?
No, so we haven't heard from.
Oh, it wasn't.
I tried to look a little bit to see if he was going to be there. I really couldn't find anything, but he's been there every year recently, so I would assume he's going to be there. So maybe over the next couple of days he'll speak. He usually does a CNBC interview, where they do those interviews out in the snow, which is always funny. They're always in big jackets.
Yeah.
But what we did hear from is a couple of weeks ago, we heard from the Bridgewater co-chief investment officer, Greg Jensen, who gave kind of Bridgewater's view on the economy. And why that's important is because Jensen is essentially taking over from Dalio in the succession plan. So Dalio's still a CIO, a co-CIO, but he's also a mentor is kind of his title for Jensen. So whatever Jensen says, you can pretty much chalk up to being Bridgewater's view, which is Dalio's view. And he kind of gave his kind of view on what's going to happen over the next year. They actually see it being the opposite of what the market thinks right now, which is soft landing and everything's fine. They think that there will be a prolonged recession, not as deep, not as sharp as something like 2008, where there was a lot of a big debt domino effect is what they spoke about. They don't see that at the moment, but they think that the Fed's going to have to be slower to act on giving stimulus if there is a recession because inflation's still high. And because their balance sheet still has $8.5 trillion of bonds on the book that they have to slowly offload. So they think the Fed will be slower to act, and that slowness to act will mean the recovery will be slower. So that's kind of their view on it. Again, we don't take economic views into our investing, but it is interesting to hear the different dynamics of what different macroeconomists see happening, playing out. Yeah, you definitely have some people saying the core drivers of inflation, like supply bottlenecks, China's lockdown, that kind of thing, are easing, and therefore inflation will ease and we'll have a soft landing. And then on the other side, you have inflation's going to come back and there's going to be a recession and the Fed's going to be slow to act. So there's kind of two sides. And as always, no one knows what the hell's going to happen. So take your pick.
As per usual. Yeah.
Yeah.
Yes, it was kind of interesting just even this article kind of saying all these, it's funny how a lot of these business leaders, they stay out, they've been successful in life. They've gotten to CEOs of big companies. They've made big bets before and it's paid off. So they speak very confidently. They puff out their chest and, I know what's going to happen in the global economy over the next year. Oh, yes, let me tell you about it. And then one person will say, yes, it's going to be a very rosy, very good place to be. And then someone else will say, very prolonged recession. Oh, no, I would never. It's just like, well, one of you's got to be wrong.
Yeah.
It just kind of gives you a reminder just to not listen to this sort of stuff. But I wouldn't listen. I wouldn't make any investment decisions based on this sort of thing. But it's interesting just paying attention to what these leaders are saying, what their arguments are, really listening to the reasoning behind it. It's like that. Remember that CNBC guy that went on the interview and I was like, oh yeah, look, we see this company's got probably a 30% chance of an upside in the next couple of weeks. And he's like, yeah, but what does the company actually do? And he's like, look, I think we're breaking up. I can't hear you. I'm sorry. I think we're breaking up. Sorry. It's like, my
ridiculous.
God.
Yeah, I think.
Listen to the reasoning.
Yeah, the way I think about it is the mechanic. Say, listening to Ray Dalio, the mechanics that he's talking about are absolutely real, and if inflation persists and there's a recession, that's a difficult choice for the Fed to make, and it could lead to a prolonged recession. That's true. But do we know inflation's going to persist? That we don't know. Are we going to go into a recession? We don't know. So the specifics we don't know, but the broad mechanics of how the economy works. If this happens, this is likely to happen. They're absolutely real. It's kind of like I enjoy listening to the broad ideas, but even Dalio, as recently as 12 months ago, was saying cash is still trash, and cash was one of the best performing asset classes in 2022, just by the fact that everything else was down so much. So he's often and can be wrong on specific timing the market decisions, but broadly, the broad trends he's been completely accurate on. So those two things can be true at the same time, if that makes sense.
Yes, very good. I agree. Should we wrap things up there?
Yeah, thanks everyone for tuning in. Hopefully this episode comes out all right. given the kind of different setup that we have this week. And unfortunately, we didn't get to any Q&As or to any questions this week, but we will try and do some next week. And if you have any questions, of course, head over to the YouTube version of the podcast and leave them as a comment on the latest episode. Or if you're on Spotify, you can just scroll down below and leave them as there's a section to ask your questions there as well. But hope everyone has a great rest of your weekend. Thanks, Brandon, as always, for joining me. And we'll see you guys next week. See you later, guys.
See you later.